Would you pay more for a house just to temporarily lower your payment for 2 years? Because that's exactly what many buyers are doing right now, because most don't even realize it. Builders love temporary buydowns. Realtors promote them. Lenders advertise a lower payment. But here's the question that nobody's asking. Are you actually saving money or just financing your own discount? So today I want to break down the truth of a temporary mortgage buydown, specifically the popular 2-1 buydown strategy, and explain when it actually makes sense and when they're simply putting financial lipstick on a much bigger affordability problem. Because contrary to what a lot of marketing says, a temporary buydown does not automatically create a good deal. In some cases, it can be incredibly strategic, but in others, it becomes an expensive illusion. Let's start with the basics. A temporary buydown does not lower your interest rate. That's one of the most misunderstood parts of this strategy. And when we look at this, if your note rate was 6.5%, that's the rate on the loan. That's the temporary buydown simply lowers the monthly payment for a short period of time by using a seller concession, builder credit, or other upfront subsidy to cover part of that payment. So for example, 6.5% the whole time. So the lower payment is real, but the rate reduction is not, and that distinction actually really matters. Now, secondly, this part nobody explains, the money for the temporary buydown is not free money. It's a subsidy that comes from somewhere, and in virtually every case, the borrower is economically paying for it through the transaction itself, because the seller always has a choice to reduce the sales price or use that same money towards a temporary buydown concession, meaning the temporary buydown is typically being funded by equity that could otherwise have gone toward a lower purchase price. And that distinction matters enormously, because when buyers walk away believing I got a lower interest rate, no, you did not. You received a temporary payment subsidy while still financing the full purchase price over 30 years at the higher interest rate. So the real question becomes, would you rather temporarily reduce your payment for 12 to 24 months or permanently reduce your loan amount and long-term interest expense? That's the comparison most buyers are never shown, and that's why temporary buydowns can sometimes become more about monthly payment optics than long-term financial optimization. Now, after everything I've said, you may think I'm completely against temporary buydowns, but I'm not. There are legitimate situations where they can make sense. But in my opinion, there's only really two of them. Number one is the first legitimate use case is when a borrower has and let me clarify this. Seller-funded concession is not free money. The buyer is still economically free. Buydown should never be used to convince someone that they can afford a payment that they realistically can't sustain later on, because eventually the real payment arrives. And if that future payment creates financial stress, the buydown didn't solve the problem, it only delayed it. So assuming you'll just refinance later is another dangerous buydowns instead of a price reduction, because it maintains the value of the entire neighborhood. So instead of reducing the sales price, they subsidize the payment temporarily. That's why buyers need to stop asking what's the payment today and start asking what's the total transaction actually going to cost me, and realistic ownership timeline, because a temporary buydown does not automatically make it good or bad. It's simply a redistribution of cash flow over time. And the real question is, does that redistribution actually align with your financial goals? So if you're considering a temporary buydown, make sure someone is showing you the short-term math, the long-term math, and the real break-even analysis, because the wrong structure can cost you tens of thousands of dollars over time. Even I'll help you compare the temporary buydown versus a permanent rate reduction, a price reduction, long-term wealth impact side by side, because every number matters, every fee matters, and every outcome matters. So I'm Todd Gerke. Reach out to me, Todd at YesTodd.com, and keep living the dream.